get these urgent calls that are like, hey, I need an audit by Friday. And I'm
Yeah, that's
like,
not going to
yeah,
happen.
I can't do an audit for you by Friday. It's, there's a huge misconception on what exactly goes into, an audit or a review, which is what you're going to need as you grow and you try to get these bigger jobs. Your bonding company is going to say, hey, I need reviewed statements or I need audited statements in order to bond these jobs. And so it goes back to that, like where on the list accounting? It's not very high sometimes. And so you've got to stay ahead of it. You've got to get these things in order before you need it, because once you need it, it's usually too late.
Hey, folks, welcome to the Mobilization Mindset podcast put on by Mobilization Funding. My name is Drew Aldridge, president of Mobilization Funding. I'm really happy to be here. This is my first podcast that I'm hosting. I know you guys are used to seeing Scott Pieper, our founder and CEO, but I'm excited to be here. And we have a great podcast for you today. We have Suzanne Bach from Saltmarsh Advisors, account, tax, and advisory firm. She is awesome. She's a friend of Mobilization Funding. Suzanne, how you doing? Thanks for being on.
Thanks. Great to be here. Thanks for having me.
You
Love to talk
know,
about taxes and accounting. So,
one of the most exciting subject matters, but we're gonna make it fun because we know how incredibly important it is. But I did notice. I have to say, Suzanne, one thing that I noticed. I was perusing on LinkedIn, and I saw on your about me that you have been an accountant since you were a kid. I mean, you were in your basement, with your abacus or of some sort.
yeah,
Tell
pretty
tell
much.
me a little bit about that.
Thanks for dating me slightly there, but yes, I was a little kid when I wanted to be an accountant, and I don't know what started it that early, but I didn't even know what a CPA was or anything like that. I just knew I wanted to help like businesses make good decisions and make money. And so yeah, I was a little kid. I used to play accountant in my basement. I would like write checks and I would manage a checkbook, and I was like six. So it did start young. I have no idea where it came from, but I've always had a passion for this kind of work. So this actually is a riveting topic to me, and it is super important. So I'm happy to share my introspect.
Yeah, no, that's awesome. So I'm just going to get right into it, Suzanne. We're talking construction companies today primarily. We all kind of understand taxes. We do our own taxes. Business owners do their own taxes at the end of the year with their accountants. But I kind of want to differentiate between doing your taxes and actually having sort of a tax plan and a tax process, like systemizing your tax process. So when you're thinking about construction companies, like kind of throughout the entire year, what are some things internally that they should be doing and considering to put themselves in the best position to work with a firm like yourselves?
Throughout the year,
Yeah.
keep up with your accounting. So we get a lot of people that come to us after the fact. I can't tell you how many people I signed up last week to do their taxes. Last week is already in 2026. So make those decisions earlier. There is not a lot we can do for somebody in 2026 for 2025. So, stay on top of it. Don't make it the last thing you think about, the last priority that you have. Put it somewhere on the top 10 list, not at the bottom of the list. So, and some of those clients we pick up in 2026, they haven't even looked at their accounting all year long. They're
Hmm.
like just going about day by day, getting everything done, getting jobs done. That's great. You want to make money and get your jobs done, but that's not the way to run a scalable business, and
Yeah.
a business that's growing. So it's pay attention to your accounting more often. Make it a priority, make it a top 10.
Yeah. So when they kind of get to that time of year where they start working with you and you kind of outline, keep up with your financial reporting, keep up with all your due diligence on that side. Like in the construction industry, what are some common pitfalls, common mistakes that construction owners will make throughout the year, or maybe even when they're filing their taxes with you and doing their taxes with you, that's kind of unique to the construction industry, things that they need to be mindful of?
Sure, tracking assets is one of the things that's really important. Whether it is a capital asset, whether it's repairs to a capital asset, you're buying trucks, you're buying equipment, things like that, tracking it.
Hmm.
Don't just dump it on the P&L somewhere where we've got to go search for it, because there are, bonus depreciation, Section 179, there's options for depreciating assets, so make sure to track those separately. Make sure to have a really clean WIP schedule with job costs by job, because for contractors, there's a couple different methods of accounting that you can use for construction that aren't available to other industries. And so you need to be tracking retainage, you need to be tracking your jobs so that we can look at the revenue recognition for the types of jobs that you have and then recognize those in the most favorable way for the taxpayer. And that's not always the same from contractor to contractor. So we have a lot of options, and that's where the planning comes in. So what the contractor can do to help us, is make sure they have a good web schedule, they're tracking their jobs, that their job schedule ties out to their P&L. That's a common mistake that we see is there's a WIP schedule and it doesn't tie to anything.
Yeah.
So, keeping track of the WIP schedule, making sure it ties back to your P&L and your balance sheet is one of the most, important things that they can track for us.
Yeah.
AR, again, AR, retainage, that sort of thing.
Yeah, no, that makes total sense. And a lot of accounting and construction from a non-CPA like myself seems, but I understand finance seems relatively complex and can be complex. And keeping up with this financial reporting, tying your WIP schedule to your financial statements and your AR reports and all that seems to be relative heavy lift. Like but it has to be done. It's a necessity. So what kind of infrastructure from a human capital standpoint does a firm or a construction company really need to do exactly what you're saying? And is it internal? Is it working with a firm like yourself who could potentially provide outsourced accountants to them? Talk to me about that infrastructure a little bit.
Sure. It's very different depending on the size of the business. So we'll just go with maybe a smaller construction company that maybe just be, just started a couple years ago and they're just getting off the ground, maybe, $5 million in revenue or something like that. They usually have been getting by on their own. And it might be the owner that's doing the QuickBooks and cutting the checks and doing the accounting. It may be the owner's sister, something like that. That is not a scalable plan. If that contractor is looking to grow, they're going to need to get an accountant, whether it's an internal accountant or an external accountant, but they're going to need to get an accountant. There's a lot of things that are very basic, paying bills, putting cash in the bank, that can be done by someone without a CPA or an accounting degree. But outside of that, it really does need a true construction accountant to do the work that is necessary
Mhm.
and to file, good tax returns that are, again, most beneficial to the taxpayer. So there could be options. It could, again, be hiring someone internally. We also do that, provide that service as well. So we do the monthly accounting for lots of construction companies. We pay their bills, we do their deposits, we do their job schedules, we provide monthly financials, we do the whole month end close. We sit down with them, we go over their financials and their WIP schedules with them. We go over industry analytics. We compare them to their competitors to kind of show where they're landing. There
Mhm.
are other firms, as good as ours that do that as well. And so I think it's very important that as a business is growing to again make this a top priority to pay attention to, like, hey, I've got to get my accounting in order, and have a professional accountant do the work, not just, Joe down the street kind of thing.
Yeah, no, that makes total sense. And let's assume I am Joe down the street, right? I've got a 5, 6, $7 million excavating company, and I'm thinking about, okay, I need to put all that sort of infrastructure in place. I need to find my solution partners, whether that be bank, accounting firm, legal. I don't want to make the assumption that everybody listening that they hear accounting, right? And it's like, okay, well, there's tax, there's these advisory services, there's audit, there's all this financial reporting. Can you kind of just, you take the audit or slash sort of reporting, tax and advisory services, and advisory I kind of consider operational,
Mhm.
and how they all link together and the difference because they're not all the same, but they're all under the Saltmarsh or other accounting firms' roof. Does that question make sense?
Yeah. So advisory is when you think of like a CFO. And a lot of companies, again, even up to say $25 million, they don't have a true CFO. They may have an accounting manager and someone that's managing the accounting, but they don't have a true CFO that's really, in there doing budgeting and forecasting and, analyzing jobs from more than just a practical standpoint, but like how do these jobs affect our tax situation? How do these jobs affect our bondability? How do these jobs affect our ability to get, financing? And so having somebody in there that can really look forward and not just backwards. And so not just be a let's put some numbers in boxes at the end of the year. That's really important. So that's where I would say the advisory comes in, is having somebody qualified to be looking ahead and helping
Mhm.
make decisions. That ties into the tax, because if you are not getting that advice throughout the year, say you pick up like these couple clients I just got this week, it's after the fact, there's not a lot I can do for you. So
Yeah.
I can do my best, but kind of what's done is done. And so tax planning is something that should be done throughout the year. You should be meeting quarterly with your tax advisor. You should be getting estimates of where your year end, is going to land, how much cash flow that you'll need to have to potentially pay any taxes. If some of the strategies aren't available to you, if you've already kind of maxed out your tax strategies and you end up having to owe, at least you can know how much. So you
Yeah.
can plan that from a cash standpoint. The review and the audit, those tie in again to all of this as well, because if you're not paying attention to all three areas, one could fall short of the other. So if you're so focused on my tax, the tax planning, you want to get rid of all the income, you don't want to pay any taxes. Well, unfortunately, then your balance sheet and your P&L now look really bad,
Yeah.
and you may not be able to get funded for, a line of credit or potential financing or something like that. You may not be able to get bonded. So
Hmm.
you've got to balance these areas, tax and the review or the audit, those have to balance, and it's like a little seesaw. So you've got to make sure that one isn't taking priority over the other. And there may be some years that one does take a priority over the other. Say you're in really good shape, you've got a line of credit, your bond guy is happy. Maybe we take a little more aggressive position on your tax return that year and try to get some more
Hmm.
deductions that year. But again, without that advisory, that's how the three kind of work together. One does it's standalone. In and of itself is not that helpful. It's a full holistic picture.
Yeah, it's a whole operation. I mean, we go back to kind of that financial back office slash partner infrastructure that you just really got to have. So, which brings me to my next question. Let's take and hopefully this makes sense. Let's take a $2 million construction company, a $20 million construction company, and a $200 million construction company. Three very different companies. At each level, taking 220, 200, what is the minimum thing that they should be focusing on where they are at their business with regard to tax strategy and tax reporting? And what is something that should be on their radar for the next leap that they're about to make in a company, assuming they're all growth companies?
Okay, so we'll start with the $2 million person. So that's going to be it's going to be a cash basis taxpayer because they're under the threshold to, so cash basis is the most advantageous. So it's going to be
Mhm.
managing cash is
What
going
do
to
you
be
mean
a
under the
major
threshold?
thing.
Let me dig into that a little bit. I don't know what you mean by that.
Yeah, sure. So there's a revenue threshold that's set by the IRS. It was 25 million for an average of 3 years. I believe OVA just raised it to 30 million a couple months ago. So if you have an average gross receipts of under 30 million, you are still allowed to file as a cash basis taxpayer. So
Okay.
that means if you collect cash, you pay tax on it. If you have AR, you haven't collected it, you don't have to pay until it's collected. So
Okay.
that's obviously the most advantageous, you
That's a
know,
huge point. That's a huge thing for these
yeah.
folks to know. I mean, I mean,
Yeah,
that's
exactly.
hugely
So you'd
advantageous.
be surprised at how many small companies I pick up that are on accrual basis for tax. And I'm like, what are we doing? I literally, like I said, just picked up a client this week who is under that threshold and they're paying on accrual basis, which means they're paying tax on all that AR that's sitting on their balance sheet.
Wow.
So they've got 8 million in AR and it's just sitting there and they're paying tax on it. So we did a conversion for this year for them from accrual basis to tax base or cash basis so that they can not pay tax on all of that AR that's
So
sitting there.
you're saying this take a $20 million company that has an average outstanding of $4 million in AR. They turn it 5 times. At the end of the
Mhm.
year, that company would be paying taxes if they were accrual on $20 million of gross sales versus like the $16 million that they received in cash.
Correct.
That's
Yeah.
hugely
Yeah.
that's a huge
Yeah,
impact on.
that's one of the biggest things that we see with the smaller companies. So under that threshold, say under 30 million in revenue over a 3-year period, is that they're on accrual because for the smaller tax preparers, that's easy, right? Their financials match their tax return, and
Yeah.
it's an easy tax return. There are more, calculations that go into converting them to cash basis for tax, but it's extremely beneficial ones. So that's something to keep in mind if you are a small contractor, is to look at the method of accounting that's being used on your tax return to report your income.
Okay.
The second thing is, like I mentioned before, there's a lot of different types of accounting methods for contractors. So if you are under that threshold and you are on cash basis, your jobs, depending on if they span over a year's time, can be recorded on a completed contract. So you don't even have to record revenue for that contract until it's completely done. So
Okay.
say it's a 2-year job, it takes 2 years to close that job. If you're on completed contract, you don't have to pay tax on that job until it's completely done.
So
And
that's
so that's
similar
another
to the
thing.
cash basis. It's sort of similar to the cash. It's still has to be kind of be a smaller business in order to do that.
It can be a larger business until you hit the threshold again to require percentage of completion, which is
Got it.
a gap, kind of a gap rule, but
Yeah.
tax follows. So once you get pushed into accrual, if you have jobs that qualify as, long-term contracts, then they are required to be percentage of completion for tax as well. So yeah, if you're on the smaller side, under 25 million, we can keep you on a completed contract basis. We can also exclude retainage, that you don't have to pay on retainage until you collect
Wow.
retainage, because sometimes you don't collect retainage for 120 days plus. So you don't want to pay tax on that either. So there's a lot of nuances of construction tax accounting that are very important for smaller companies. Now, once you're over that threshold, so if we moved up to the $200 million guy, he doesn't even have to think about that stuff because he's already
Gotcha.
on accrual. He's got to do percentage of completion. But for the smaller ones, that should be on their radar. They should be looking at, what is my method of accounting for tax? How am I tracking my jobs properly so that my CPA can make these decisions on whether it's completed contract or not? Um, you asked me something else. What you said, what should they be worried about and what's on their radar for the future? Is that?
Yeah, what should be the next thing that they should be considering for the future? But I just wanted to touch on that. I'm still kind of my mind's blown a little bit on the accrual versus the cash accounting and the tax
Sure.
implication. In your experience reviewing a number of companies, within that threshold, lower than that threshold, where they're
Mhm.
able to actually report on a cash basis, what's the largest sort of miss that you've seen where they actually filed as accrual, but they could have been doing on a cash basis where they had to come out of pocket for such a large amount of money for taxes? Because in the
Oh
construction
yeah,
industry, cash flow is so tight naturally by the
yeah.
payment terms of the
I
industry.
mean, you're talking hundreds of thousands of dollars. I mean, like I said, this client right now, they're a couple years away from hitting the threshold, but they're in the say $29 million range right now. So they've got to have 3 years of that performance to move. But their tax bill last year was over $1 million. So we'll end up this year moving them to cash and
Got it.
hopefully throwing them into a loss this year, so that they won't have to pay any more this year. But you can't retroactively do a change of accounting. So last year's kind of last year's. So it's a timing thing. Ultimately, it will all bleed out. But cash flow, like you said, is never. It's always tight for contractors. It's usually tight anyway. So
Yeah.
you really again want to pay attention to these things because they now have overpaid essentially their taxes, and it's now sitting with the IRS and not with them. It could be making money for them, it could be in their checking accounts, but instead it's sitting at the IRS. And so had they filed last year on cash basis, they'd have an extra, say, I think it was about $950,000 sitting in their checking account right now, and they don't. you
I
know
mean, that's significant, especially when you want to be a growth company, which kind of
Yeah, Again, it all goes back to that. Like if you're looking to grow, all of this stuff matters. If you are just looking to stay the same, then these issues are less important for you. But
Yeah.
I rarely talk to those contractors. All my contractors are wanting to grow. They want to do things better. They need to get the infrastructure in place. That's where they're headed. If you're just kind of status quo, then it's a timing thing, and you got plenty of cash, then fine. Do as you wish. But I just rarely run across those guys.
So that's good segue into my next question. When you can, I mean, we work with a ton of companies that are wanting to do more jobs, wanting to do larger jobs, wanting to bring on more teammates. I mean, the list goes on. So, with regard to tax planning, is there anything unique that a company that plans to grow 20, 30, 40% year over year need to consider that is unique to, say,
So
a lifestyle company?
Yeah, more so, honestly, it's and again, we've just run across this a lot lately, a lot of urgent requests for bonding or FDOT licensing, which requires an audit if you're looking at jobs over 1 million. And we get these urgent calls that are like, "Hey, I need an audit by Friday." And I'm
Yeah, that's
like,
not going to
yeah,
happen.
I can't do an audit for you by Friday. There's a huge misconception on what exactly goes into, an audit or a review, which is what you're going to need as you grow and you try to get these bigger jobs. Your bonding company is going to say, hey, I need reviewed statements or I need audited statements in order to bond these jobs. And so it goes back to that, like where on the list accounting? It's not very high sometimes. And so you've got to stay ahead of it. You've got to get these things in order before you need it, because once you need it, it's usually too late.
Hmm.
And people are calling me in the middle of tax season. It's our busiest season. And they're like, hey, I need this thing by Friday. And I'm like, well, first of all, no good CPA has time right now to squeeze in a brand new audit in the middle of February. And so getting ahead of this stuff, planning for this stuff before you need it. If you are like, hey, we're in growth mode, start getting reviewed financial statements now. Get the things in order to
Yeah.
do that now. Have your tax returns done by a professional CPA now, because later the bonding company is going to be like, well, I can't use any of the stuff that you have. Because use H&R Block or something,
Yeah.
and that's ridiculous because they don't even do that. But you see my point is you have to think about it proactively, not reactively. So
Hmm.
think about where you want your business to be in a year and start making your accounting fit to where you want to be in a year. So it's more planning around your financial statements than it is around your taxes.
Makes total sense. And just on that note, real quick, I don't want to assume everybody knows the difference between an audit, reviewed, and then just regular financial statements. Can you just run through the different levels of financial reporting and sort of what that means and who's preparing them and what level of quality they are?
Sure. So all three is independent assurance that your financial statements are not materially misstated. So all that jargon means that your financial statements are accurate.
Okay.
And I know you used to be in banking and you're still in the financing industry. And so you guys look to us to say, hey, we need, reviewed statements or, compiled statements to be able to trust these financial statements
Yeah.
because it means somebody independent of the company has looked at them, they've kicked the tires, they've opened the hood, and we're giving assurance that yes, these financial statements can be used, to rely upon them in order to make decisions like bonding and financing.
Yeah.
So a compiled statement is the lowest level of assurance. And maybe some people in my industry will cringe when I say this, but they're kind of junk. I don't ever recommend clients get compilations. I think they're worthless. They're stupid. Reviewed. Now that's a level up. So that's the second level of assurance. And that's really where we dive in. We're doing analytics. We're talking to people. We're comparing against industry standards. We're trying to find out, if things are recorded in the right place, if your job gain, the gain or the fade on a margin of your job is consistent with what you're estimating, things like that.
Hmm.
One step above that is called an audit, and that is full blown intrusive. We are in your offices, pulling your documents, checking contracts. We're sending confirmations to your customers to make sure they say they owe you what you say they owe you.
Yeah.
We're not only kicking the tires, but taking the tire off and refilling the tire, to make sure that the inside seal is still with it. So the audit is the most intrusive level, and again, that's for even a medium-sized contractor. An audit is an 80 to 120 hour job. So
Hmm.
the fact that people think you can just get one done by Friday, is unheard of. A normal review is, again, probably 60 to 100 hours as
Okay.
well. So of time on the CPA. They have to be issued by a licensed CPA. They can't just be issued by a lot of firms that don't have CPAs. They just are EA or something like that. They're not allowed to issue. You have to have a certain level of insurance, and you have to have a certain quality in your firm. So you have to make sure you're getting a firm that is allowed to issue those types of reports. So it is a next kind of level up.
Makes total sense. Thanks for outlining that, and I think that provided a lot of clarity for our viewers because I mean, there's a lot of jargon. There's compiled,
Yeah.
reviewed, audit, and then you got your QuickBook. Like, what at what point do we have to start considering, and
Yeah,
what
we
are
get
they?
questions all the time that are like, I need a CPA letter. And I'm like, a letter? We don't give letters.
Yeah,
We
no,
don't
no,
we don't just send letters. So there's definitely some jargon used out in the marketplace that isn't consistent with our standards that we have to follow. So it's always important to find out, does the person need compiled or reviewed or audited statements? Because when we get these requests for, I need a CPA letter, I'm like, I don't know what that is.
yeah.
Let me talk to your guy, your person, to find out what they mean by letter.
So for our last few minutes here, I got two questions. Um, and then we're gonna do like a rapid fire at the end, just like five quick questions that
Lightning
are like,
round.
yeah, lightning round. All right. But two quick questions before that. Number one, what are like call it 3 to 4 things that is unique to the construction company that could be levers for more for a more tax beneficial situation at the end of the year. Like, I mean, think about depreciation, think about all kinds of other types of things operationally that our construction owners could be doing to
Mhm.
put themselves in a more favorable tax position at the end of the year. That's unique to the
Sure.
construction industry.
Yeah, it goes back to that. I feel like a broken record, but tracking your jobs, making sure that you're putting the right, costs with the right jobs, that you're
Okay.
tracking retainage, that you're tracking AR properly, that you're recording your payables appropriately. Because what happens a lot of time is the revenue will get pushed into the year 25, but then the expense somehow lands in 26 because you're not taking into consideration that maybe that subcontractor sent you that invoice late, or maybe that parts bill didn't come until later. So you've got your revenue in this year, but your costs are in next year. So you want to make sure those go together. So all the costs for those jobs need to be booked in the year that you've got the revenue coming in. That's really important.
Hmm.
Tracking, equipment, depreciation, things like that. Getting in front of the year end. So maybe you've got some excess income. We can give bonuses to your people. We can make contributions to
Yeah.
401k. Yeah. We can do things like that. And so just getting ahead of the year, that's really just the most important thing, is have a projection done in Q4 by a CPA. They can tell you, hey, this is where you're sitting for taxable income for the year. And if you've got some excess, then you've got time to make those decisions. Do I need to buy new equipment? Can I make a bonus? Should I take any distributions? Things like that. You've got some time to plan, because once you get into the next year, it's just too late and there's not much we can do.
Okay, and from all the companies that you've really looked at, what are some, and you don't obviously don't use names of companies or anything like that, but what are like 3 or 4 instances where you've said, "Holy smokes, that is a red flag. Nobody should be ever doing that. This has messed up your taxes. We're gonna have to get you out of all kinds of pain right now." Like 3 examples. Can you think of any that are kind of
Yeah.
funny or cool little
So,
story?
well, I have lots of funny ones, but m- most recently, I would say we're finding this more and more and more, is that contractors are doing work in multiple states and they're not reporting anything in those states. And
Okay.
so that's a huge problem. States are getting more strict. They're cracking down. They're sending letters. They want to know, hey, do you have people, boots on the ground? Are you selling product in our state? Are you doing work in our state? So many people just completely ignore that they're doing anything in any other states. We've also had a lot of international stuff lately, which is again very similar. Like, oh yeah, by the way, I'm doing a job in Puerto Rico. Really, that's good to know. That's very good to know. So those are huge red flags when you're doing work internationally. You're doing work in multiple states and you're not reporting those, and nobody knows about them. You will eventually, be found out. That is never good. It's another thing. Owning planes
Yeah.
is a very scrutinized area of the IRS right now. Planes are they're a red flag to the IRS. So they're highly
Yeah.
scrutinized and they're picking those apart. They want to see, the mileage logs. They want to see they're getting picked for audit more often than not lately. So that has been a very sensitive area that we've had to, make sure that our clients are prepared for and ready for should they be audited. Large discretionary spending, large travel and expense budgets, large entertainment budgets. Those are always, kind of red flags for the IRS. If you've got, 1 million in EBITDA, but you had 8 million in entertainment expenses, that
Yeah.
can be kind of upside down. Okay, that's a lot of entertainment. So you've got to make sure that your ratios, like percentage of, say, meals and entertainment in comparison to your revenue is
Yeah.
on track and fits with, some industry standards. That can be a big red flag.
Keep the kids or the wife's G-Wagon off the balance sheet is kind of what you're saying.
Yeah,
All right. Got it.
it's okay to have the G Wagon on the balance sheet. This is something we see common. It's okay to have the G Wagon on the balance sheet, but she should be tracking her mileage. So she's obviously not using that G Wagon just for business. So she needs to
Yeah.
be tracking her personal mileage. And as long as she's taking a W-2 for that personal mileage, it's all fine. So again, there's ways that to legally, have the G Wagon on the balance sheet, but it's just be careful, be careful that you're crossing your T's and dotting your I's.
Makes total sense. So, okay. All right. We're going to do quick lightning round, then we're done. Suzanne, you've been great. All right. Lightning round. Number one,
Should I like
biggest tax
stretch?
myth. All right. Stretch it out. You good? All right.
Yeah. All right.
Biggest tax myth contractors believe.
Oh, biggest tax myth. There's so many. That just because my friend Steve did it means I can do it.
Oh, that's that's awesome. Most common missed deduction.
Ooh, missed deduction. Missed deduction. I don't know that anybody.
Because
Yes,
they're
we'll
all
go with
working with
bonus.
you. It's because they're all working with you. They don't miss the deductions.
Exactly.
So
I'm
they're
trying
working
to
with
think
you.
of, it's usually probably like a depreciation type of thing. So
Okay.
people like we take over a return that they just took straight line and really they could have been more aggressive and taken bonus. Oh, you know what? Probably like cost seg studies. If you're buying property, it's a study that you do on property that you buy to try to get a more favorable depreciable life. That's probably the one of the more missed ones.
Awesome. One tax move every contractor should at least ask about.
What method of accounting they're on.
Okay, yeah, you kind of already hit on that.
Yeah,
It's
I mean
perfect.
that one we just see so much. And so that like if I were a contractor listening right now, I would be pulling out my tax return and looking on to find out what method of accounting I'm on because that would be the number one question. And if you're taking again like bonus depreciation, if you're paying tax at the bottom, if you're paying tax at the end of the year, there's some questions to be had as far as what deductions are you taking? Have you taken them all? I hear a lot, we made more than I have cash. I don't have cash. You say I made
Mhm.
this much, but I don't have cash. That indicates we need to dive a little deeper.
Awesome. Suzanne, you crushed it. We got Suzanne
All right.
Bach from Saltmarsh Advisors. She was awesome, incredibly informative. She went above and beyond. We thank you for taking the time to be on Mobilization Mindset, Mobilization Funding. Myself, Scott, thank you so much, and we'll see you around soon.
Yeah, it's been great. So much fun. Thanks for having me. Appreciate it.
Awesome.